the Secure Act allows annuities to be sold in qualified retirement plans, which I think that I speak for all of us when I say that that has got to be the dumbest thing since sliced bread.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my two colleagues, Dan Weiss and Nathaniel Leach. We have no guest today, so we picked a topic out of a hat, and we decided to talk about the advisor evolution. It's an interesting topic within our industry because in order to really get our industry and understand the incentives of the advisor you're speaking with, you really have to understand how the advisor became to be what it is today. And before we jump into it, there's one comment I always like to make. Please, 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 if you enjoy our episode, like, share, and subscribe to our podcast channels. That includes YouTube, Spotify, Apple Podcasts, the works. We're all over the place. So please share it, like it, subscribe, do everything you can to help promote us. We'd really appreciate it. Dan, I know that you're going to be leading this ship today, so I'm going to let you kick us off.
Okay, well, I think it always makes sense to start at the starting point for something like this. So let's do that. In the beginning, who would like to take that as to where we kind of begin this ship? And I mean, we can go back pretty far. We can talk a few hundred years. But I think it probably makes sense to bring it up in the last, say, 100 years and start perhaps this conversation in the early 1900s and talk about, let's start there.
Sure.
So do we throw it to the history guy or Tim, do you want to kick it off?
I think Nathaniel's looking at me like, Tim, you better kick this off so I don't have to talk about this. So overall, our starting point, if we went back, as Dan mentioned, 100 years, 90 years, 80 years, you really see the structure or the beginning of the stock exchange. So what's people don't probably realize today is the way that the stock exchange worked back then is there was actual stock certificates, physical paper that people would receive. So in order to get those stock certificates from the exchange to the individual holder of said stock certificate, you needed an intermediary, which was called really a broker, maybe at the time. I don't know what the technical name was, maybe a stock exchange broker, where they would actually do the transaction between the individual or the institution and the exchange. And they would actually physically deliver those stock certificates from the exchange to those people. So that's how it all got started. If you then start kind of moving forward on where this has really evolved, is that you keep going forward, is what people started realizing about the advisor is that it was very close to the end consumer or the client. So they started incentivizing these individuals to sell the stock and sell instruments to the clientele. So that's really where you start seeing a lot of these advisors selling a product, not necessarily a service. And you have the advent of mutual funds, you know, the advent of other vehicles that could be sold. So the advisor would go ahead and start selling these to the individual. Now, as you keep going, and I think probably around the 1970s to 1980s is what also, because the advisor again was selling certain things to clients, is insurance companies were like, hey, you guys are really close to the clients that we want to talk to. Maybe you should start selling insurance products that may have some bent of investments in it, because we are doing some investments for, I don't know, a whole life or a universal life policy. So then the advisor started being the mouthpiece to those types of products. And the advisors started making some good money. Now, all of a sudden you see the 1990s, right, where you see the advent of technology really picking up, where all of a sudden now you can start doing buying and selling of stocks online or via computers. So there's no more reason to be able to have this intermediary, but do some of this transactions. Now the cost of those transactions were still pretty high. They weren't cheap by any means. So you still needed an individual to do it because it just made more sense. But as we continue down the path and get to today, what's happened is that the advisor's position to be the kind of mouthpiece or the distribution system for a lot of these products is still there. It's still actually the vast majority of what our industry does, but it's also become very commoditized. Fees have come down. You don't make as much money. There just isn't as much incentive to do that because of technology. Technology is allowed for now. Trading costs are at zero for most stocks and some ETFs and some mutual funds. If you look at Fidelity, if you look at TD Ameritrade / Schwab these days, they've dropped their commissions down to nothing. So they're not even getting paid for people to transact on and through their platforms. So this overall idea has become really commoditized, and the price has just continued to drop and drop and drop. In addition, you have newer instruments like ETFs or other things that are also really, really cheap from what's called a expense ratio. So then those are competing with things called mutual funds, where mutual funds still have higher expense ratios, AKA the fee at which people have to pay in order for this manager to manage their money. And so a lot of people have become more educated on this, and they're starting to shift where they put their money, which again is shifting the overall construct of the advisor, because these ETFs or these lower expense ratios are typically passively invested or indexed. So overall, what's happening is that the advisor was very much set to sell products and sell certain investment vehicles. But because it's becoming so commoditized, what's really happening today is you're seeing a lot of advisors in our fashion that are really providing more what's called financial planning or advice, similar to a lawyer, but they're kind of, even if you read certain articles or certain publications, it's more of like a life coach, but it's really focused around finances specifically and having a really good competence within that area and helping people make decisions. So the fee structures have changed, a lot's changed, but that's kind of how, you start from the beginning and you work your all the way up, where the advisors just slowly transition, both structurally as well as the incentives.
So what Tim is talking about when he speaks about the fees is you can basically look at it for hundreds of years, these brokers would take a commission. That's how they made their money. It was transactional. These commissions have come down with time. Simultaneously, in about, I think, the 70s or 80s, actually, when it became more in vogue, there was a shift in the revenue generation for advisors from commissions, which, as Tim said, is still the majority. That's accurate. Has shifted more to what's called AUM, which is assets under management revenue generation, which means that advisors take a percentage of whatever assets they manage. That is how we charge. In addition, in the most recent past, there's also been a shift from the AUM model now to this generational shift of paying a fixed fee for planning services, which we also do. So, which we have a combination of both. So there's been this shift over time. Now, what's important about this distinction is that the commission fees, as Tim said, have tapered off. There's no longer as much money in that anymore. Where the brokers are now making their money is in what's called order flow. This is a big topic of discussion that came up during the Robinhood GameStop fiasco earlier in 2021. What's happening was that since commissions have come down to zero, basically, Robinhood has to make money somehow. So what they did was they took all of these orders on their platform and they pushed them through these market makers like Citadel Securities. And Robinhood gets paid by Citadel to provide these trades to them. And then Citadel then executes these trades. So that's where Robinhood is making most of their money, and then Citadel is making money on the spread between the buys and sells that they are making throughout the day. So it's a very transactionary nature. We don't like this kind of model for ourselves as advisors because it's a one-time thing. The same thing goes for the insurance policies that Tim mentioned that advisors sell to their clients. We don't do much of that, if at all, because it's most likely not in the client's best interest, because there are high fees that these clients are being charged. And in addition, they're incentivized to sell these to clients because they receive these high, in some cases, recurring commissions. That's where their incentives lie. So that's why there was a shift to this AUM model, which was basically for advisors to be paid for their performance. So they would then take a percentage of whatever they were managing. But in the last 10 years or so, there's been this shift to this paying a fixed fee for a service, because the millennial generation now wants more in tune, and this is really where Tim can speak more to it better than I. They want more interaction with their advisors. They want to know, if this, then what? Then if that, then what? They want to know what that is. And most of these millennials don't have a lot of assets. So the previous fee generation model of an AUM percentage of an AUM model doesn't quite make sense for them, because then an advisor couldn't make any money, couldn't stay in business, couldn't provide advice, couldn't do their fiduciary duty, and then they wouldn't be in business. So that's why there's been a shift now to paying a fixed fee to advisors, such that they can then provide an ongoing recurring service to these millennial generation clients that are now getting into full swing in their earning years, in their 20s and 30s.
And Nathaniel brings up a really good point from the standpoint of like the fiduciary and the incentive. And I think that is also a big shift, is that what the fixed fee does is it creates transparency, and it creates an alignment that is not really seen in our industry today. Because if you're a true just fixed fee or retainer fee advisor, I no longer have any incentive to tell you anything other than what's in your best interest, because I've removed that interest of, oh, well, if I sell you this life insurance policy, or, oh, if I sell you this is how I continue to make my revenues. And then in addition, where there's been a lot of backlash or a lot of fight towards the AUM model, is that the AUM model then also can potentially force someone just to try to gather your assets, right? Which also creates a conflict of interest between the client and the advisor. So the fee model and the retainer model is coming from a lot of different angles, other than just where the client stands and where it sits. Is some advisors will promote and continue to promote that it creates a better alignment with one another. Those fee models also range. A lot of advisors that we see, they can charge based off your income, based off of the assets, what's now called AUA, or assets under advisement. There's a lot of different ways to kind of slice and dice it, but it's definitely a newer model that is being played with. It's an ongoing conversation on the fee model standpoint, but it definitely is switching, and it's changing. It's changing, I would say, pretty rapidly for our industry.
I want to take a second just to sum up so far and make sense of everything that we've said. So obviously there's an evolution from a stockbroker to, which still exists today, to different roles. And there's a lot of different players now in the mix that are regulated differently, which we'll talk about, and have different functions on top of that. And they, of course, get paid differently because of this, right? So as the evolution of the roles have moved over the course of the last 100 years, so has the evolution of how those people get paid and the different ways to do so. We've talked a little bit, perhaps unintentionally, about who some of those players happen to be: traders, investment advisors, of course, retailers, which we haven't talked about, but we will here in a second. Tim just mentioned the regulatory bodies, right? With all these different people, individuals, businesses involved, that means different regulations for different kinds of businesses. And that gets very, very confusing. If we could take some of the conversation and make a shift and spend a little bit of time perhaps talking about some of the legislation that has been around for a long time, maybe some that has not been around as long, that has been working towards, whether intentional or not, changing the landscape. And perhaps the best place to start with that is to talk about the fiduciary responsibility versus a suitability standard, which, if anybody knows anything from a regulation standpoint, that is usually where they start the conversation.
Yeah. I think the fiduciary, it's nice to see the fiduciary concept being pushed pretty heavily. The CFP has been, is a huge body organization that's trying to push it, both from a marketing and just getting the general public to understand. It's also come down with just, in recent years, just regulation that's been popped up. So a lot of our clients now are saying, "Are you fiduciary?" They don't quite understand what it means, but they know that it's something they should be asking, and it's something that's important. Versus what Dan just mentioned is like the suitability rule. And to kind of break those down in a very simplistic manner, the fiduciary responsibility is, depending on the license that you hold, you are required to act in the best interest of your client at all times. And Nathaniel can correct me if I'm wrong when it comes to this detail, but I believe it's the fiduciary responsibility is focused directly from a SEC/state regulatory standpoint. It's the assets that you manage or the assets that you have. It's the investments is really where it gets the regulatory body is oversees that, correct? It's specifically the investments. So what's interesting about that is the CFP has recently come out from a regulatory standpoint and has stated that the fiduciary responsibility is applied to any advice given. So and that's something that I should know, because I'll come back to the CFP, but that's what they've come out and said is that, no, this is going to focus on everything that you're going to advise if you want to hold the CFP certification. So that's which is interesting. Now you flip that and go to the suitability clause or the suitability rule. And what that states is, as long as the advisor can prove that the investment or the product sold was suitable for the client, they have no legal ramifications for that. Now, this was a really, really big deal when some of the regulations were coming down for example, Edward Jones, because what also is the new regulation state is that they wanted to force Edward Jones as an entity to be liable for any advisor in their system, and so that means that if the advisor screwed up, it was going to funnel all the way back up to the main corporation, which opened up Edward Jones to a significant amount of risk based off the amount of advisors that they had. So that's like a little hole within some of these regulations that were coming out, but that's a very big distinction between the two, because it really is focusing on really more of the client risk. But the one argument that a lot of the suitability clause will have, or advisors there, is like, well, I'm always going to act in your best interest. Yeah, I mean, I get it. I understand. But at the end of the day, your incentive, your actual legal liability is not tied to that, where the fiduciary it actually is. But again, as Nathaniel clarified for me, it is specifically within investments. But then if you have a CFP designation or a certification, that means you actually have to be a fiduciary on all advice given. So it's a really important distinction to make within our industry.
And could we maybe just go backtrack and talk about the players here? So, for example, why is Edward Jones subject to the suitability rule? Is Edward Jones not an RIA? So what is an RIA? What is a broker dealer, trader, etc.?
Sure. Well, we could start with like the two high level ones, right? So what we've been speaking about is registered investment advisor as an overall entity for our industry. And that is typically regulated by the SEC or the state, where go ahead.
If I may, that was put into place by the Investment Advisor Act of 1940. That was placed into law, RIA.
Yep. And then what then happened, or what you also have, is what's called a broker. Now, as Nathaniel just mentioned, why do you speak of Edward Jones? Edward Jones and their advisors are technically brokers. They're actually regulated by FINRA. So they're actually two different regulatory bodies that are regulating both of these advisors. Now, a small snippet is there's actually been talk about removing brokers from having the ability to call themselves a financial advisor. That is actually now a topic of discussion. So the reason why that's such a big distinction is because of the licensing that these individuals hold, where they are licensed to sell a product. They aren't technically licensed to give advice. So a broker has a Series 7 or a Series 66 or a combination of both, or they have a bunch of other series that are in there, and they're able to sell a product. Where an investment advisor representative, which is then typically underneath an RIA structure, is going to be regulated by, like I mentioned, the SEC or the state, depending on the firm. And what that's going to do is they're going to hold what's called a Series 65, which is really a kind of a combination of the 7 and the 66. But what it allows them to do is that allows them to give financial advice, provide financial advice, and then there are the regulatory responsibility is a fiduciary responsibility to their end client. So if you want to look at other players, traders, brokers, different things, that's a really large conversation that there's a lot of players within the financial industry, services industry. What I'm really highlighting is a financial advisor and removing an asset manager, a trader. It's really brokers and an IAR or an investment advisory representative.
And I want to speak towards the distinction that Tim made too before we hit that piece, which is that somebody will say, of course, they're doing what is in the best interest of their client. The issue there, and I lived this personally when I was getting into the industry quite some time ago, where I had involvement with an organization that was a broker dealer, so they were not an RIA, and shadowed a broker dealer who, no doubt in my mind, had his clients at his heart, the best interest in mind. Problem was that he was limited on the research that he can conduct, whatever you want to call that as research, and what he could put in front of his clients. And that came down from somebody who didn't know his clients, and quite frankly, didn't care about him either. And so that's the issue, is it becomes a case of the weakest link. And so whenever we speak to give you an idea here, whenever we speak to a potential client, we always take the time, whether they ask us or not to go through what we would view as non-negotiables and understanding these different players. And one of those non-negotiables right off the bat is we talk about this fiduciary responsibility, and flat out say, look, you could be speaking with the most intelligent, trustworthy, person that you can find, and maybe they fit every box you check. But if they're not a fiduciary, it means that somewhere down the line, somebody has elected to not make the decision to put your best interests ahead of their own. And I got a problem with that, because those settings usually do not include an independent advisor. Thus, someone else is ultimately making that decision. That's a problem.
Dan,
at least to me.
I agree 100%. And what's funny is I have another small snippet about your experience, and I was just thinking about it. I was kind of laughing to myself. This will probably be a good one for our millennial listeners or the younger generation. Is what RIAs used to promote for like one of their advantages? Open architecture, which essentially meant that they had open architecture, the ability to go outside of what the company was telling them to do. And that isn't that new. My first job in this industry, which was approximately 9-10 years ago, so not even a decade, about a decade, they would pitch, one of their main points was open architecture. We have the ability to invest in whatever we want. That was 10 years ago. Like, if you think about that now and where we are today, that people, the younger generation, are like, what? You can just go get the best product or the best price? No. And that's still happening today in 2021.
I mean, I remember, speaking of fees, and I know Nathaniel will say this too. I remember making my first trade, and there were commissions of $50 a trade. Right? Like we've come in some ways a long way. In others,
yeah,
we haven't. Yes, right. In others, we haven't. So we have some recent legislation we could talk about too. such as the Secure Act. And particularly inside of that act, what I'm referring to is the incentive to push products like annuities. As we're talking about players, and Tim referenced too that, for example, the insurance industry is varying, has become, and always has been, I guess, at least to my knowledge, closely related to the rest of finances. And so you have insurance agents that is different than some of these other players we talked about that can play ball when it comes to investing in the form of a product like an annuity. Nathaniel, would you talk a little bit about the component inside the Secure Act that now allows for annuities to become a much more utilized investment vehicle?
So, from my understanding, the Secure Act allows annuities to be sold in qualified retirement plans, which I think that I speak for all of us when I say that that has got to be the dumbest thing since sliced bread reversed. I don't know how else to say it. Sliced bread is an awesome thing. So I mean to say the reverse of that.
Inverse that thought process, is Nathaniel.
That's right. I think it's the dumbest thing ever. And the reason for that is we already talked about a little bit, was that annuities charge huge fees for one. If you try to get out of the annuity, they charge you another fee. The provider of that annuity, so the insurance provider who's selling you that annuity, once you get into that annuity, they make money. You stay in that annuity, you continue to make money. You try and get out of that annuity, they're going to make money. And then they're going to charge you an arm and a leg for that money. And an annuity, for most people, doesn't make sense. So this
and as Dan was talking about this, this just gets me fired up. This concept gets me fired up in a lot of different ways. And the reason why it gets me fired, it gets me fired up is, I will agree that I'm not going to bash annuities. That's not our job. Our job is to make sure that whatever product or service or whatever it may be for our client, that it's an appropriate placement, because there are places where annuities do make sense for an individual. So as we always say, it depends. It totally depends. But the problem is that if you get annuities and 401ks, people already today will default to Fidelity's 2050 retirement target date fund, right? Because people don't even know that they have it. They don't even know that they log in. And what does Fidelity do? Fidelity goes in and says, okay, I'm going to make this super cheap for the administration. You don't have to, it doesn't cost very much. But what we're going to do is I'm going to force you to put my funds into your lineup. And then what I'm also going to do is I'm going to force you to make my funds your default. And because I guarantee what Fidelity's done on the back end is looked at the data and said, guess what? When people put their money in our funds, they typically don't get out. And then what do? They make money on the expense ratio within that fund. So again, not saying Fidelity funds are bad, but the overall objective of that is because they know that people aren't making these changes. They do know that. Let's not sugarcoat that. And what is also frustrating is what this is also doing is it's putting the advisory space as only a distribution system. And that really is what the advisory space has been for years, is how do we shove more products and services through you because you're a direct mouthpiece to the client. And I am sick and tired of our profession being that, because A, it gives us a bad reputation, B, we can be 110 times better, and C, you're not actually providing advice. And that really is the role of our industry. And that's where it needs to go and continue to go moving forward. If an advisor is going to give a product, they should only be advising on it because they have no incentive to make money, but because it makes sense for the end client. Because at the end of the day, our jobs solely should be the success of the client. And we have done a poor job on a million different levels with that core concept. So that Secure Act is also just saying like, okay, great, we have more products. How can we shove it down everybody's throat in different ways? And just can't with that.
I think, Tim, a lot of your frustration that we share with you too comes from the disguise too, where the public the public thinks that the profession is doing one thing or has the credentials to do one thing, and our inside viewpoint is that it doesn't. And so there's a lack of professionalism, in a sense, in the profession that that is known.
And lack of education. It's like, if you're going to do this, how are you going to educate the end client on what it actually is that you're putting your money into? Because they aren't doing that. I can tell you that much.
And that, I think, would be a great segue to actually speak about what we think the future will hold, what we're seeing now, what those differences look like, and where we think things can go from a regulation standpoint, but from also just a platform standpoint, from a planning standpoint, as we believe that true financial planning is truly in its infancy, and how that can indeed and hopefully will change what, again, this process looks like, and yet evolve much further.
Where would you want to hit, Dan? Which one of those do you want to go down that hole on? Because I'm happy to hit any of those. Regulatory, products and services. Where do you want to start?
Well, I think the best place to start here is to really talk about the movement of the retail investor. I think it was in 2019. I got to date things now based on COVID, because I remember being in the office. So I believe it was in 2019 where the typical retail investor took over and took the majority stake of those who trade in the U.S. markets. And that's a major statement that has been pushed by the concept of indexing for the last 12 years has really brought that to the forefront. Yes,
Perhaps we should clarify what you're talking about, retail investor versus what an institutional investor is. So we are institutional investors, technically. So that means that we have access to what is called institutional pricing, which gives us access to cheaper transaction costs for options, because the options still do carry a commission cost. We get access to certain classes of mutual funds that, if you were a do-it-yourself, or what is also called a retail client, retail person, you go out and you invest on your own, you wouldn't have access to those kinds of funds. So
yeah, and I think that, Dan's, to answer your question of where is the retail investor going, I think to answer that question, you have to understand where generational differences, I think, is a really big, important piece, because I believe, and again, this is me completely guessing here, but if you were to probably do research on why the retail investor has been so influential, is because the millennial generation is becoming a very large part of the population. And what the millennial generation has over maybe Generation X and the baby boomers is that we've grown up with technology. And what that's allowed us to do is we've grown up inside the information age. And so the expectations of a baby boomer versus a millennial are vastly different. And Dan, you're the best one in the firm to explain the differences in expectations between those two generations. But overall, the expectation, I don't even say the expectation, it's just the ability to interact with technology in the younger generation has allowed for them to access trades, indexation, passive investing. And what it's also done, though, and it's really interesting, is that our millennial or younger clients, again, ranging anywhere from the ages of 25 up to 45, is they also require more expertise out of us. They aren't just going to shake our hand at the golf course and say, "Hey, you're a good dude. Yeah, well, we trust you. You're good." It's just not going to happen that way, because they can be educated. The internet has democratized or has leveled the playing field with the amount of information that someone can access. So someone can do their own research. It might be a lot of work to do, but they could definitely do it on their own. What we do is not rocket science. The reason why we have a profession is because we do it every day. So that knowledge compounding that knowledge is extremely efficient, right? And that's why you have markets and different things. So I think in order to understand that retail surge is because more and more people have access to it. I think it also has to play with the decrease in commissions. So you're giving more access to individuals. I think you can also probably put some of it towards gamification or habit forming technology that forces more of a fun, thrill, this is exciting type of an environment, specifically when you're investing in the markets. But all of these things are extremely important to understand, because what also technology is doing is you're becoming so niche within your product, like in fintech banks is something that's fascinating, is they're going after certain demographics, AKA they may be going after the LGBTQ plus community specifically to give them certain benefits within that community. That's how niche they're becoming. Why? Because the data that they can receive, they can understand that client and customer base extremely, extremely well. So they're getting and then that community, right, as in that example, is receiving exactly what they want. So you're becoming more customized, specific towards those individual investors. And that's what the millennial generation or the up and coming generations are going to expect is not, hey, again, let's go golf and I trust you. It's like, no, no, no. What can you provide me? What can you provide me specifically? And if you can't, I'm going to go next door, AKA to the other website that is very similar to you, but they're going to give me what I want. And so to really understand that, that's really where it's coming to be. Now, where that is then taking the advisor profession is it's no longer good enough to be an asset manager within a wealth management firm. And that's how a lot of RIAs were really built. And it's really then focusing on, well, how else can I provide value to my client? Because with the client and the younger generations are going to say, well, you haven't beat the index in 10 years. Well, now you haven't beat it in 12 years. Why would I pay you more to earn less? That is the argument. And so then all of a sudden now our profession's like scrambling, saying, okay, wait, hold on. Well, we're really not the manager because we really outsourced to mutual funds, but we're going to do this financial planning to provide you some sort of value. And that's really where financial planning has become a bigger thing. Now, it's been slow to gather traction, but I can tell you that the reason why financial planning has not taken off is because if you actually want to plan, it's a lot more work. It's a worse business model relative to doing assets under management, because you have to put in way more work, a lot more data to do it correctly. And the one thing that I have a hard time with our industry now is the transparency of service. Everybody will say we're comprehensive, holistic planning. I absolutely hate that crap. It is terrible. Why? Because it's like sausage. You don't want to know how the sausage is being made. Because if you go inside these firms and you start understanding what they're actually providing, I can tell you from experience, ain't shit. And so you don't understand how that can be put together. And so that's also the difficulty within this planning, is because people don't do it because the incentive to do it isn't there. But I can tell you that the firms are starting to understand it. It is what's going to have to happen. And it will force our profession more into a professional manner in advice giving than what it has been in the last 100 years. It will. It's coming.
To clarify Tim's comment about comprehensive and holistic planning, these are good things. This is what
they're good things.
This is what an advisor should be doing. What we're saying is that most advisors who say they're doing that are not. And that is a absolute judgment on our part. But considering what we have seen from our competitors nationwide, we think we have a leg to stand on.
Great clarification. It's going to be really interesting. I do think, and there's been people that follow this better than I do within the industry, that the CFP is going to become a regulatory body specifically for financial planners. I think that potentially could happen, where all of a sudden you're going to, in order to be considered a financial planner, you have to have a CFP, or you have to be regulated by the CFP specifically. I do think that organization is moving in that direction. You're also seeing a lot of different things when it comes with the SEC in the state and different rules and who can, because what's happening is there's more RIAs. So the SEC can't do their audits because they're so backed up. So now they're potentially relying on the state to do it, because it's becoming this transition and move towards this kind of structure, because the masses are starting to say, No longer do I want somebody who has a suitability standard. I now want a fiduciary. And so the people who are on the suitability standard, that's why I brought it up earlier, is they'll say, well, of course I'm acting in your best interest. I want to keep your business. But now the masters are saying, no, it's not good enough, which is great. And that's pushing our industry forward. So all of these confluence of factors of technology, cutting fees, where the advising space is at, just overall where things are, is it's pushing it towards the industry of gaining traction, of becoming an actual profession. But in addition, what needs to happen is more education, more, forcing more expertise in the industry, because that's what you're starting to do. Is you're no longer selling a service, you're selling advice. And that is something that is can be difficult to do. I think from a tech standpoint, the technology has to completely rethink. And if it doesn't, people are going to fall behind because of what clients expect and what advisors need in order to provide the level of advice that's expected by the end client. So there's a lot of things, I think, in the next 10 years, where you'll see a lot of different changes and adjustments. And honestly, as much as I get fired up about this, it's going to be for the benefit of the client, which is absolutely awesome. It will come. And then it's the more getting the education out to making sure the client knows where to go.
And leaving a lasting thought, I really think that I want to focus on change. We often say this comment as it relates specifically to investing in the markets, but obviously I'm going to push it to be more broad than that. What we often talk about is that when things, meaning markets particularly, but things in general, we'll say, are on the up, that they're going really, really well, people always act as if they're always going to continue to go up, but they never do. They always eventually turn directions. And the opposite is true on the other end too. When things are not what you want to see and they're bad, people get in their heads, oh my God, this is always going to be this case. It's never going to be good again. And they're wrong. It always eventually, at some point, it swings the opposite way, and things get better again too. Because change is going to happen regardless if you want it, are comfortable with it or not. And I can tell you that we're going to see a lot of changes in this never-ending evolution. And those that will really thrive, they don't have to be the smartest people out there. It's going to be those that are willing to adapt and make those changes and really follow that innovative trend. It has been the story of America.
I could talk about this for days on years on end. This is a great subject, but in order for me to wrap up my final thoughts, I think, as Dan was saying, I'm excited for the next 10 years of our space. I'm excited to see where it takes. And what I'm really excited, and I think the mass population needs to start expecting more out of an advisor. And the first step to that is to be educated and understanding the incentives and what they should and can do for you. So as I was mentioning, as Nathaniel clarified, comprehensive and holistic planning is a wonderful thing, and it's exactly what should be happening. But you got to start understanding that there's a difference in the execution behind that. And if you can understand that, you can find advisors, because we're not the only ones. I'm not saying we have something completely special, but it's not a large amount or the large population of advisors that are doing similar things that we do, but it can be done. So expect it, push it, because what it's going to do is then push the advisor, which is going to make the advisor profession better. And it's going to then make the client success better. So
competition at its finest is what we're going for in our profession. I just hope that what we talked about here today has been educational to our listeners. I hope that you've enjoyed learning about it. This is just barely scratching the surface. We could talk about this for days. And with that, I'd like to echo Tim's comments about educate yourself. Be aware of what is out there and push. If you already have an advisor, push your advisor to be better. And if you don't, find an advisor who will push it for you, because ultimately you want an advisor who's going to look out for you.
Thank you for joining us tonight, and we appreciate you evolving with us. Take care. Have a great evening.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,